things in cash, it's hard to substantiate those expenses.
Right.
Number 3, keep a mileage log. Most people think that, well, I'll get a mileage log together if I ever get audited. Well, gosh, when you do get audited, you forget where you went. It's too late from that point. And not only that, this is a really good tracker for leads as to, well, I went out to this place, that place, and really, how am I spending my time and my resources?
Right, right.
So again, very, very, not only for organization for tax purposes, but just organization for business in general.
Now, John, you're starting to sound like a sales broker.
What's funny is that when I went to school, I thought, what? I don't ever want to be in sales. You know what? We are all salespeople. We have to be.
Right.
And if you sell a service or anything that is going to help others, then it's just a great feeling all around. And that's what I do every day.
Yeah.
And, that's what you do every day, Eric, and that's great.
Mm-hmm.
So the other thing here is meals and travel itinerary. So if you go out to meals with clients or potential clients or colleagues, write something in the back of that receipt of, for example, met with Eric Frazier or met with John Gonzalez.
Right.
And therefore, when you get to a tax audit, or better yet, just to prepare your tax returns, you'll know exactly what happened in that instance. And I'll roll back to having a bookkeeper. Oh, wow, this is very important. The bookkeeper will be able to put into the system as to where you went and why that expense was a good one.
Right.
Last one here of tips is start planning for 2011. There's nothing worse than getting surprising information.
Right.
When you give all of your information to your tax person, you shouldn't be crossing your fingers and saying, I hope I get a refund. You should know already. There should be some sort of inclination as to, yes, I did pretty well. There was somewhat of a tax rate that I'm going to have to deal with, and this is what I put aside for it. Plan. Very, very, very important. I know we have just a few minutes, so let me go over some tax strategies here.
Okay, all right.
All of our real estate agents, this is what we talk about. Now, because of the bonus rates and things we were talking about just earlier, go out and buy a vehicle. If you're already looking to buy a vehicle, this is the year to do that, especially an SUV vehicle that is over 6,000 pounds in weight. You can still get a $25,000 write-off at the very least for a vehicle that you purchase in 2011. And here's a really important one, Eric. It doesn't have to be brand new anymore. It used to have to be brand new, but you can go out there and get a really nice used SUV and be able to write it off all in one shot.
So, John, the write-off of $25,000 has to be equal to or greater than the vehicle's price, right?
Exactly.
Okay. All right. So, wow,
Yep.
that's a dollar for dollar impact, or what would you say for every dollar of write-off? What's a net impact?
That's a very good question because, see, if you're self-employed, not working through a company or a corporation, you've got to pay Social Security and Medicare.
Right.
So if your tax rate is normally at the 25% bracket, plus the 15.3% of Social Security and Medicare,
Right.
plus 10% for California, you're at the 60% tax bracket.
Right.
So if you buy a $20,000 vehicle, that right there just saved you $13,000 in tax.
Wow.
That's huge. So when you look at, well, how much did I spend on my vehicle? Technically, you only spent $7,000 on a $20,000 vehicle. That's immense difference there.
Wow. So the thing to do is go buy a hybrid SUV, right?
Yeah,
To minimize the
hybrid SUV
impact.
would work.
Yeah, minimize the cost of gas. That's for 2011, or for those who maybe
That's for
bought
2011.
Okay.
And for 2010, you still get a 50% depreciation, so it's still a high dollar amount. Not as good as what I just said, but it's still a very high dollar amount.
So is that 50% depreciation the first year, or is that over a period of time?
That's the first year.
Okay. All right.
Yeah, that's why they call it a bonus depreciation, because it's a bonus in the first year.
Okay.
Yep.
Great.
The second is hire your children. Because your children are at a lower tax bracket, you can, in essence, move taxable dollars from you that might be at the higher tax bracket to your kids. And there are some great little, what would you call it, loopholes in which you don't have to pay Social Security and Medicare on their pay. And if their pay is low enough, you might not even have to pay any taxes on theirs. So it's almost as a free write-off there if you do it right.
So, John, when you hire your kids, though, are you actually employ them, right? They they are employees of the company, and they have to have a job, right? And they have to actually do some kind of work, because you could get audited in that situation too, right?
Yep, exactly. So let's say that they're taking out the trash, or let's say that they're doing marketing for you, which is a very good one, where they're part of your pictures, or they're going and doing some filing work for you in the office. There's so many things that they can do. And in some situations, gosh, you can go out there and have them sell for you as well.
Right, right. So is there a limitation?
But
is there
there is no limitation, but definitely talk to your tax advisor. They'll be able to give you a very good idea. For example, if you make $50,000 a year and you're paying your child $60,000, that doesn't make sense anymore.
Sounds good to me, though, John. I mean,
it works. But I mean, your child's going to wind up paying the taxes on it now, and
that's
that doesn't
right.
work out at all.
That's right. That's right.
Yep.
So I guess so. Aren't you just really transferring some of the tax burden to your children, or what's the benefit there then?
Well, remember, your tax bracket is usually higher than your children's.
Right. Okay.
So by sending some income over to them, they're going to pay taxes at their rate. So let me give you an example. Let's say that you get paid $50,000 a year, and your tax rate is 25%.
Okay.
Well, if you shift over $5,000 to your child is at the 0% tax bracket for that amount. You just got a $5,000 write-off without a problem.
Now, do you have to be self-employed, or can you be a wage earner?
Question. This works as a self-employed company, not as a wage earner. A wage earner is not allowed to deduct these kind of expenses, at least as powerful as this.
Okay, right. Gotcha.
So, yeah, that still definitely works. And there are some limitations as to how much you can pay out and not be taxed at your rate or their rate. So that's definitely something you want to talk to your tax professional about.
Okay.
So next one here, health insurance. Health insurance in 2010 is more deductible than it ever has been. In the past, you would be able to deduct as a self-employed individual, you'd be able to deduct your health insurance against your regular income. Now you're allowed to deduct it against your business income. Again, it's that 60% rate that I was talking to you about in that example. So health insurance is very important here. Number 4, retirement plans, 401k plans, SEP IRAs, and life insurance products. Those whole life insurance products are pretty good investments for long-term purposes, because if you put money into that, if you take money out once you're retired, it's non-taxable. Better than any 401k plan, because the 401k plan, you got a deduction on it today. Hey, that's great, but down the road when you decide to take the money out, you might have to pay some taxes on that. And the idea is our tax rates are going to increase at some point.
Right.
I mean, they didn't do it this last year here, but they're going to have to go up at some point. I mean, I was just listening to the news that our Social Security is upside down.
Mm-hmm. Well, the thinking is that by investing in 401k, you're avoiding, your current tax rate. But when you retire, your income will be less, and so you will have a lower tax rate on those monies you're deferring. But that may not be the case if taxes continue to go up. And, do you really want to make less money when you retire these days? As opposed to now. Yeah, we're going to need it, right?
I agree with you.
So that so those whole life, variable life, life insurance type products provide that tax exempt or tax deferral opportunity.
Absolutely. So again, this is one of those things that you want to talk to your advisor about, where your advisor really should look at your whole picture as opposed to just the tax picture. For example, what I talk to my clients about is that, hey, that's going to be a really good tax deduction, but here we're throwing $1 to get 30 cents back. So definitely talk to your advisor, have a whole plan put together, and that's my 5th tax strategy there, is plan. If we can plan ahead of time of what your anticipated income is going to be and what we can do in order to reduce or completely take away your tax burden, that's worth a whole lot more than 1 or 2 deals for the year. Right. So if you put the time into it, this is going to pay you so much more over. Eric, I also have a standard sort of expense worksheet that I can email out to anyone that wants.
Okay.
Just realtor deductions and things of that nature. They can just email me, and I can go ahead and send that over to them, or they're welcome to go on my website at gonzalezcpa.com and grab one of those as well.
You know, John, I just noticed here that your web address and email address is not on the flyer. I don't know how that happened.
But I thought it was.
Yeah, I thought it was too. Maybe I'm looking at a draft. But why don't you give your email address one more time and web address, and then we're going to open up the lines for questions. And while we're waiting for the questions to line up, I want you to talk about the Wealth Series.
Absolutely. So our website address is www.gonzalezcpa.com, and that's spelled GONZALEZCPA.com. We also have a wealth series a series of seminars that we've put together in the past, and basically the wealth series is a 3-part seminar that will take you from personal assessment to creating a plan for your personal, business, and investment wealth growth. Rebuilding personal wealth is the first part of the most important part of your rebuilding. And some of the topics that we cover here is financial health assessments, personal budgeting, very important, tax strategies, credits and risks, and finally, creating your plan for success. Many businesses open up have their business plans. We as individuals need to have a business plan as well. And I know, Eric, you talk about this all the time, and this is something that's very important, and that's something that I'm sure you've used in your life.
Mm-hmm. Yeah. What's the saying? People don't fail to plan. How's it go? But they don't succeed because they fail to plan. And planning is everything. Strategies are everything. And surrounding yourself with people like yourself to help you in your planning is everything. So, operator, let's open up the line for some questions and give instructions for questions.
Thank you. Ladies and gentlemen, if you would like to ask a question or have a comment, please press star then 1.
So, John, while we're waiting for questions, and operator, just let me know who's on the line. How long have you been practicing?
Well, I've been practicing in the CPA world here. Gosh, it's going to be 19 years now, getting close to 20. So I've been doing this for quite a long time, and what's really attracted me to accounting and tax is the real estate aspects of things.
Right.
I used to deal with some pretty nice-sized firms dealing with REITs and REMICs, and what I realized is that the well-to-do individuals that we always dealt with, I mean, we're talking about $500 million in assets or more, were always real estate owners. Never had any business owners that did not have real estate holdings as their majority of investments.
Wow. And so you saw that firsthand dealing with multimillionaires and looking at, the mix, if you will, of their portfolio.
Absolutely. Very few of them were in the stock market, which is really
that's interesting.
Backwards.
Mm-hmm.
Because, I mean, those are the conservative best winners is real estate. Usually has been.
Right. Now, you also hold a broker's license, and you're an investor. Did you start that before you become a CPA, or did you do that after the fact? What got you into that?
I did that after the fact, and just because I was purchasing a lot of properties, and at first I thought, well, it might be a good idea for me to get my commission on the properties that I buy as well.
Sure.
It never has really worked out that way. I think I just hold it in sort of just a certificate, so to speak.
I see.
But I really have not used my broker's license very much.
I see. Okay. Operator, do we have any questions?
We do. Our first question is from Jamie. Please go ahead.
Hi, Jamie.
I have 2 questions. You mentioned about using children paying out expenses, and I am giving out like 1099, but I'd like to know the figure. Is a single male, 20 years old. How much they have to make in order to not to pay taxes? The limit is what, 7,000, 8,000?
Yeah, so if they're over the age of 18, it's $7,800 before they have to pay any regular income taxes. Now, the idea is you don't want to 1099 them. You actually want to fill out a W-2 for them. Because they're your child, if you send them a W-2, you or them are not subject to Social Security and Medicare. But if you pay them as a 1099 employee, then they will have to pay their own Social Security and Medicare.
Oh, so I have to send out W-2s.
Exactly. And by the way, the W-2s are due January 31st, so you got to step on it.
Even though they are not